I need a Red Bull for Mike. I fell asleep after page 2, and I think the last presentation proves the likely failure of the bill as it currently stands. I won't repeat in any shape or form. Speakers beforehand have delved very well into the various schemes that are there. So I'm not going to go back over them all again. I would just say, this is all about debt. And other countries have attempted to do this, and other countries have failed to do it, and a lot more have succeeded in doing it. In relation to the Swedish experience, they went down exactly the same route as we went down. And after failure upon failure, they had no choice but to introduce a sort of an organisation that had to effect deals. France did exactly the same. France did it slightly better. They required the deals to be sent to the central bank in advance, which seemed to get a little reaction from some of the creditors. Creditors don't like the central bank getting involved in unreasonable behaviour. So I think this is all about debt. We all know that. Everyone here has vast experience in relation to dealing with people who are in trouble. It is not just about mortgage debt. In each mortgage holder who's in difficulty, of which there are currently 169,000, 169,000. So the scale of this crisis is enormous. Those who are affected by debt, each on the last MABS report, have an average of 4 other unsecured debts of which they're having difficulty dealing with. So the scale is huge. Add to that those people then who are in business, who've got business debts, who've got buy-to-let and multiple properties. All the various statistics and information are there to show that this is a monumental crisis that will require effective handling in order to ensure that those debtors get back to economic production, to be able to be relevant members of society, and also do so with a very important thing intact, and that's their head. We are dealing with vulnerable people, and everybody in this room will come across people who are vulnerable. And no matter how big a man or a woman is, when they borrowed 1, 2, 3, 400,000 or 1, 2, 3, 4 million, when they are affected by debt, they are reduced back to the most basic of human beings. And it's a very, very important point that people keep forgetting. Just because he or she was given 10, 20, 30 million does not mean they're the greatest genius in the world. It means some lunatic gave them money. Who pays? I know this was mentioned earlier on. This is a very, very important point. There were a couple of things that our speakers earlier on forgot to mention. Number one, before a PIP can be appointed, and this is very relevant in the event of a dispute arising, before a PIP can be appointed, the debtor, as proud and as big or as bold and as small as they are, must engage with their creditors themselves. They must show that they have attempted to deal with their creditors in advance. And it's a very, very important point. It's not an automatic appointment of a PIP. The Act clearly states that the debtor must have made every attempt to have engaged with their creditors. Proving that, debating it, will be good fun in the future. The second thing is in relation to who pays. I know that Mike's example there said a $6,000 fee for the mumbo jumbo we just looked at there lends me to believe, and experience will tell, that many of the creditors out there currently will avoid, like the plague, the insolvency bill. Because along with the PIP having to supervise a period of 4 to 5 to 6 years, the bank also has to do that. And anybody who has affected any deals with the banks over the last 2 years, there will be a debt settlement arrangement type proposal for any residual debt. But built into that, the creditor, without prompting, will also put in a proposal for one-off payment. And as the one-off payment becomes attractive for the creditors, because they do not want a situation of having to supervise a debtor who has already been in trouble once for a period of 5 years. You know, trying to negotiate with 5 creditors at one time, I think the last example shows clearly the difficulty will be held. But payment is a very, very important feature of this. Who pays and when? And, you know, this is the corpse being asked to pay for the funeral. And the funny part is that the corpse might need to be invited to the damn funeral if some creditors have their way. So it needs to be very clearly set out that there are 3 categories of people here, of which the most vulnerable will not be able to afford to pay for these services. Though those who will be able to take some funds with the consent of the creditors from businesses or from cash flow or from landlords who've got tenants who will be able to pay for insolvency services. If I was an insolvency business, and don't get me wrong, I have absolutely no issue, nor is any debtor issue of anybody providing a profession from this business. This is a required business, is needed. That's not the issue. The issue at hand is there's a void there for the most vulnerable people who are affected by debt, and there's a fee structure yet to be announced, yet to be negotiated, and most certainly most of those people will not have those fees and will not be able to pay for that service, and therefore there will be a two-tiered, if not a three-tiered service of debtor, which is wholly unacceptable. And as the last part of the slide says, those who are goosed will be left behind. There is a big question in relation to the morality of those people who are in difficulty in relation to creditors and debtors and not having funds available. MABS was an opportune organisation which, in my view, government have failed miserably in relation to beefing up MABS. 5 years ago when the crisis hit, MABS was the logical debtor service that should have been established. It currently, believe it or not, is made up of 52 limited companies, each reporting to the Citizens Information Board, funded by us to the tune of 18.5 million, and made up of 256 staff, all exceptionally well qualified. That should have been isolated from CIB, independently funded, and had its own board with its own CEO, not already funded. The remarkable part was additional funds weren't required, and that leaves a very bitter taste in people's mouths as to why that simple step was taken. 52 limited companies. Can you imagine the audit fees and all that rubbish? Probably auditor might be here, sorry. The priority here in the system is very, very simple. For those in business, those who are landlords, or those who are have one single property, protecting the family home is essential. I'm not talking about a 7-bedroom mansion in the middle of Mullingar where there's 2 people there and 3 dogs. That's what I'm talking about. And again, we'll deal with the trust issue very, very shortly. The priority has to be protecting the family home. The entire system is currently wrong. The larger banks, AIB, EBS and other banks, will currently require you to avail of any of their MARS solutions not to pay any of their creditors. So just bear in mind what you've just heard for the last 2.5 hours from the various speakers and how the hypothetical bill will work. And, you know, most of us in the world like to deal, as Gus said, this is like a play or a film. It is, and it's made up of a phenomenal amount of dramatics. I don't like the fiction, I prefer the factual ones. And the issue here is that you cannot have a system where there are banks in this state currently telling debtors not to pay other creditors in order to facilitate a possible, and in inverted commas, a possible deal, including, say, a split mortgage or any such other remedy. That is wholly unacceptable. The plan should be, and all of the banks actually remarkably have sat back on the backsides for 4 years and have allowed other creditors completely run amok and take money that would be and should be entitled to go towards a secure creditor. However, they've sat back and allowed a complete chaotic system arise, which has disadvantaged them and, very importantly, disadvantaged the debtor. So, moving forward, the family home must be secured at all costs. This bill alleges to do that. It's absolutely unclear, and you know, everyone has to get very concerned. If a debtor's watching here today, looking at the various presenters, when everybody agrees there's significant flaws with the bill, that doesn't spell a bed of roses for debtors. The insolvency process, I think, has been, you know, dramatically well marked out, and we have 3 different options. And really, the key component is for those who are really goosed currently, no matter what size of debt they have a number of immediate options involving the key anomaly, which is the bankruptcy. And I think Alan explained the myth quite well. They can avail of the current bankruptcy, which we know is archaic. The only advantage of the current bankruptcy is it's immediate. The new bankruptcy might be 3 years, with the following 5 years add-on, depending on good behaviour, whether the headmistress decides you've done well or not. They may add on a further 5 years. But in order to qualify for bankruptcy under the new regime, you must first negotiate yourself with your creditors and fail. You must then appoint a PIP and fail. You must be in the mortgage arrears resolution process for 6 months and fail. Then and only then can you apply for bankruptcy, which can be opposed. The current arrangement here and the current arrangement in the UK, for those who are really goosed, need to have a very clear understanding. They may very well be best availing of the current system, because remarkably, the new insolvency bill, despite its flaws, has one little gem in it, and that is that those who avail of the current bankruptcy system and are caught for 12 years convert to 3 years with the new bill. So there's a huge benefit to people, and I know of a number that will avail of that very shortly. Run down to Justice Dunn, put your hand up, I'm goosed, I'm out of here, take the hit for now, and then when the new Act is actually up and running, convert back to 3 years, and it might just knock out the 5-year add-on. Trust. This is all about trust, and I think the unspoken word and the elephant in the room is trust. The public don't trust creditors or banks. In fact, they despise them. The reality is, and I think if the truth is being told, creditors and the banks don't trust their customer. And that is fundamentally where this has all gone wrong. There's an obsessive compulsive disorder, respectfully, among creditors attempting to try and think that 5% of those debtors are trying to pull a stroke. Most debtors in this state are not like some of the well-publicised debtors who've been marched through the Irish and the UK courts trying to pull strokes. Most Irish debtors, the vast majority of them, are trying to do the honest thing, do the right thing and pay back their debts. They're not being afforded an adequate chance, and this bill most certainly does not afford them any level of control. And this is all about control, this is all about power, of which some creditors have more than others. And it's interesting to see some of the examples earlier on whereby there will be an element of battle between some of the various creditors amongst each other. And not everyone is trying to pull a stroke. The bill, the veto, the bill in my view can't work. The veto is detrimental. It's complicated. It allows too much control and power. The lack of independence is a disaster. And the PR business and game, and I look forward to maybe in 2 years' time coming back here again, and let's deal with the statistics as opposed to the spin and see how many have availed of this. I do believe most creditors will avoid it if possible, and that some of the work of the PIP will be done unofficially, and it has huge advantage to both from a cost perspective. There are a huge amount of issues currently out there that have undermined the bill in relation to various codes that the MABs have with the banks, the Banking Federation policy, the current Banking Federation policy, which is to try and piggyback and help your fellow Banking Federation member and screw the rest of the creditors wherever they might be. So there's a huge amount of conflict out there currently, and there is an attempt to have first up, best dressed. And really, the end of this, for me, is unfortunately not one that I can throw in a huge amount of jokes and say, those who have said there's a huge experience, this is unprecedented, uncharted waters. And in uncharted waters, there are many sharks. And those debtors that are out there at the moment watching and being watched by people who are saying and claiming to have experience, there is no experience. This is all new to everybody. And people need to be very, very clear that there are significant conflicts within this for people, both here and outside here, who've worked for creditors and are still working for creditors. So debtors' needs most certainly are not being attended to within this bill. They're left very vulnerable, they're left very open, and it's going to take a significant amount of winding. And those of you who are dealing with debtors will know clearly the bank's behaviour in the last 5 years in relation to trying to do deals, and it depends on the guy or the girl you're dealing with at the bank. All of us have experience of dealing with the same bank, same creditor, and gotten completely different responses, completely different perspectives, and completely different deals. So there's a very, very incoherent approach to the creditors there. So I leave you with, as I say, those who are dealing with this area, to be mindful that not everybody is trying to pull a stroke, that most people coming to you or coming elsewhere are genuinely trying to deal with this, and therefore they need to be given a slight break. No one's looking for a freebie here. This is a splitting and a sharing of the burden is what's being required, but to do so in a safe and a compassionate environment as opposed to being done in a sea where all there is predators. Thank you.
Thank you, David. A very even-handed contribution. I thought he had a swipe at everybody in equal measure. But that's also what we're here for. This is a new territory for all of us. And it's a new regime with plenty of challenges. And we could well be back here again in 12 months' time or in 2 years' time, looking back over the experience. I'm very conscious this has been a long afternoon. It's a fairly heavy subject, but we do have time for some questions. And if there's any questions from the floor, we'll be glad to take them on the top table. Thank you.
Just a question from Michael. You mentioned you don't believe that a number being hit the levels of what is expected. So, charging is all mentioned. I'm just wondering, do you not feel there's quite a big pent demand for something like this to go on?
Well, yeah, there's definitely demand for it. I think a lot of sorry.
I was just wondering if Michael mentioned he didn't expect too much of a pent-up demand on the arrangements. I was wondering for a bit more clarification on given there's a feeling out there that the public have been waiting for something like this for a long time.
Well, I think you're right. There is a demand for an updated insolvency service, or an updated insolvency legislation. I think the problem is that a lot of creditors won't want to enter into a process. Certainly, the banks won't want to be seen to be writing down a debt on one occasion and then having another scheme where they're refusing to write it down. I think a lot of debtors aren't going to want to have their name splashed on an insolvency register. While I think there will be a take-up, I just don't think it's going to hit the level. It's certainly not in the first couple of years because of the timing of the legislation. I think eventually we might see increased numbers, but I think in the interim we're certainly not going to see a massive increase in the numbers.
Good. A question at the back from the lady.
Is there any evidence that, given that this legislation would be the banks are actually being more reasonable with their debtors? The bank, I think that the consensus used to be the banks would want to process that the very some arrangement. Is that happening more often now?
I can only speak to my own experience with a particular bank, and yes, there is been a level of engagement. It's on the agenda, I'd safely say, and I know there are other bank representatives here, it's on the agenda of all the banks as to what the impact of this new regime will be, both in terms of resources, human resources in terms of dealing with them, the solutions that will emerge from this, but also the capital impact on the balance sheets of the banks as a result of potential write-downs here. The banks are also facing Basel III in 2019, which looks like, according to the Governor of the Central Bank, a potential 6 billion hit coming down the track, and that will impair balance sheets. So the banks' preferences have to be a consensual workout rather than this forced situation. So the short answer to your question, as I understand it, yes, the banks are gearing up to deal with this new reality that will be brought into play probably by Q2 of this year.
And in your experience, does that consensual agreement, does that do the credit write-down?
I'm not sure that the banks have got their head around that piece yet, but I think it's the unspoken reality, in my view, that there will have to be structured forgiveness against some backdrop, some agreed workout that will have to involve a level of forgiveness of debt. Because if you don't get it in a consensual workout, you're going to get it through the new arrangements. So do I do it early or do I do it late? And the point is very fairly made here. I mean, a creditor's voluntary liquidation will run you between 4,000 and 10,000 if it's fairly straightforward. An examinership will run you 20,000 or so in fees. Who has the money to fund these sort of new arrangements? The banks won't want to spend the money, and certainly the debtors may not have it. So I do see a situation where, yes, there will be a lot of practical discussions taking place with the banks over the next year or two against this backdrop. Any other questions? The lady?
Yeah, and there are some obligations which are allowed carrying out if you are an installed bankrupt. Does the new article and the
Well, under the fitness and probity, any undischarged bankrupt, it would, if you're working in a financially regulated arena.
Yes.
Under the fitness and probity regime, which is under the Central Bank Reform Act, if you're an undischarged bankrupt, you mightn't be able to carry out a function in a regulated entity, be it an insurance broker working in a bank, especially as a director of pre-approval control function. So being an undischarged bankrupt, or if you fail in a restructure, so if you fail in your PIA or debt solution agreement, debt settlement agreement, it could have an effect if you're working in the financially regulated arena. I'm unaware of any other jobs that it could have an implication on.
This gentleman here.
I was just curious in relation to the English system inside of this. Well, if somebody was to come in and ask for through bankruptcy or personal insolvency arrangement, what are the likelihood of you getting credit down the line? What's the effect on the credit rating? And is there a difference between the different arrangements, or is it a case that because you've gone through all these arrangements that you're actually goose to use the words being used there for maybe 10, 15, 20 years into the future?
Certainly from an English perspective, the experience was there was a great deal of stigma attached to bankruptcy and affecting credit rating, and it goes on your record for 6 years. You'd have difficulties under the old regime, certainly when there was 3 years discharge. It was very difficult to get credit afterwards. But anecdotally, after they changed the system in England, people were making themselves bankrupt, massive credit card liabilities, being discharged from their bankruptcy, and then 6 months later being offered credit cards again with the same people who had previously made them bankrupt with higher interest, higher credit rates. So I think the stigma is certainly, as we've reduced the discharge period, has come down. And yes, it does affect your credit rating. You won't walk into the high street and get a high street mortgage, but it's not as damning as you might think, certainly in your own regime.
And you come to one of these voluntary arrangements, does that go on your credit rating?
Voluntary arrangements, yes. Again, it's on your credit rating, but again, it's more felt of you're dealing with your process, and so yes, it can have an effect, but it doesn't have a massive effect.
Very good.
Small point on that, really. Just, I suppose generally the other thing is that ultimately we have to remember that banks make their money from lending, and one of the practical things that will happen as people come through these arrangements, there will be more accurate data, because remember there's the 12-month review. Somebody's in this for 3 years, 4 years, 5 years, or somebody mentioned they could exit earlier. But during all that time, there's a lot of now documented information as to their income, their expenditure, their performance. And I would say from our own experience that we wouldn't be surprised if that body of people come back into the borrowing market much faster than people would expect, purely because of that history, and also because of the reason that a lot of people ended up there in the first place, which was kind of, if we talk about 2007 as the perfect storm, which affected financial institutions themselves and the individuals, that it's inevitable that people who go through this process, a certain percentage will have learned lessons, and therefore be very good borrowers in the future. There's no reason why not.
Do you think we will see people losing their family homes? And if so, what sort of people might they be? I mean, it's all about protecting family homes in reality.
Well, I think there's a provision in the Act that if the family home was seen to be in some way disproportionately valuable, or it's not the word that's used, unnecessary to support and sustain the family, then in that situation you could see it forming part of the arrangement as proposed by the PIP. So what scale, what's appropriate, these are all issues that will be teased out, you can be certain, before the courts in the foreseeable future.
If you look at somebody who may sell their family home by support, they'll never be homeless.
That's both the philosophy and the spirit behind the Act, that nobody will be left homeless as a result of this, and that the family will be protected. David, you might have a comment on that. I'm not sure if that speaker is working. No. That might be.
I think the spirit is a useful word. There's 100,000 people currently waiting on social housing. and there's a mortgage to rent scheme which the government introduced last year, and there's the mortgage arrears resolution process which is governed by the central bank, and recently we've got a mortgage arrears solutions, none of which are binding on a bank. There's 7 mortgage to rent schemes. So, it's very much back to the individual decision of a bank as to whether to pursue you for the house, whether the house is voluntarily sold, which is the new show in town is a voluntary sale, which the bank will kindly pay for the solicitor and kindly pay for the auctioneer. No sleeping bags, but will kindly, or no tenants. So I think the facts that exist currently are that there's a void, there's a little hole in the current legislation, which means there's an disproportionate presentation of those repossessions that currently exist. But I think it's very much an individual basis, and I think the PIA does very clearly say it's there to protect the family home. That's subject back to the veto, back to the creditor rules again. So I think it tread with caution. The intention, the spirit is there, but I think the actions will be clearer in the months to come or years to come.
And just one question before you finish. Just on the quite negative letters, and as we talk about all this, we say there isn't anything else really there. Would you prefer not to have it at all, or is it something we think it can be worked through? The government clearly stated that if arrangements don't start coming through quickly, they can review it back and review the veto as well.
I think if you go back to the actions of creditors for the last 5 years, and as I said earlier on, there's 169,000 people in arrears, 19,500 beyond 2 years in arrears. With those figures in mind, the intent and spirit of the creditors shows in the recent central bank report, which gives 10 split loans. 10. So an insolvency bill that allows the creditor to have all the power, in my view, is not the way to ensure the Creditors Act. Believe me, make nothing sure in the world, I would absolutely love this to work. I don't believe it can work simply because the actions of creditors for the last 5 years show that when in control, they will take control. You give a veto to a creditor, they'll take it. Don't expect them to give it back at the swap shop. They're not going to do that. So I think it's there. It needs to be worked within, but I actually believe the creditors will try and avoid it. I think it will be worked out. There's no reason why Mike's deal earlier on couldn't be done by anybody on a negotiation basis without any 5-year plan, simply agreed and done and dusted much quicker, or a simpler household one can be done very quickly. So I think it will force those deals to be done, but they'll be done in openly. One thing Mike did mention is very, very important is if you avail of the insolvency process, you've got to bear in mind the spirit of this, your name appears on a register. Not the deal, but your name appears in the register, clearly showing you availed of this. So we have to question the spirit when it's all one-way traffic.